Okay, so let's have a look now at how this concept works. What I'm going to do is just take you through an illustration of the principles. We won't worry about numbers for the moment, just the idea and the concept of how this works. So here we have your typical Canadian home, and we can divide the debt that's owed on that conceptually. And so what we have over here is your typical debt, your typical mortgage, which is not tax deductible. And it's going to take us a bunch of time to pay that off because we owe a bunch of money on it. So this is the side we owe all the money on, and this is what we call the debt. Your mortgage, the amount that you owe. So let's say each month we make a payment, and what happens is that each month a tiny bit gets paid down. All right? This is obviously exaggerated because you're going to need 300 of these tiny payments, or of your monthly payments. Payments aren't tiny, to get all the way through this. Now remember, we're using non-tax deductible money. So that's money that we've already been taxed on after we earned it. So it's costing us a lot to do this. You understand that typically you're going to pay somewhere in between 100 to 200% in interest costs in addition to the principal that you're going to pay down on your mortgage. So this is a very inefficient way to do things. Well, let's look at another way that we could do it using our concept. Except this time, we're going to use tax-deductible payments. So how do we do that? Well, let's say we've made a payment over here on this side. We've made our monthly payment. So now we've freed up some additional, we've paid down some of our principal. So what if we had a way to reborrow that money? So we move that over here onto the tax-deductible side. We borrow what we've already paid down, and we put it into an investment. Oh, wait a minute. Now we remember, if we borrow money to invest, the interest costs are tax-deductible. And we put it into this investment bucket here, and that investment is going to, let's say, pay us a monthly income. So now, we've taken this and we've put it into our investment here, our 2 monthly payments, and that's now going to pay us a monthly income. Well, let's just take that monthly income and use it to pay down some more of our mortgage. But you ask, well, how can I do that? Because if I make a payment on my mortgage, normally, an additional payment, I get a penalty. And that's a funny thing, isn't it? The bank wants to give you a bunch of money, free cars, toasters, whatever it is, to come and move your mortgage to their bank. But if you want to move your mortgage out, if you want to pay your mortgage down, you're going to pay a big penalty. Well, using this method, and the proper setup, you're not going to pay any kind of penalty. So, now, next month when we make a payment, we've not only got our normal equity pay down from our normal mortgage payment, but we've got a little bit of income coming from our investment that we're going to apply in here as well. All right. So, we've actually made some progress. We've paid down a little bit more of our mortgage. Now, if we, again, use our principal and reborrow the amount we paid down in equity in our monthly payment, and we reborrow the little bit that we paid down through the income from our investment, and then we move all that down into here. So we're increasing the amount of our investment. Okay. So again, this is what CRA refers to as cash damming. Others have referred to it as debt swapping, because what we're doing is we're swapping non-tax deductible debt for tax deductible debt. There's one more piece here, and that is that we have interest costs on this, but the interest costs here are now tax deductible. So that's going to give us a tax credit or a tax reduction. And what we're going to do is we're going to take our tax reduction generated by our payment, and we're also going to apply that over here and use it to pay down our mortgage a little bit more. So we've got our monthly payment now. We've got our investment income. And we've got a little bit of a tax refund that Canada Revenue Agency is now giving us, because the interest costs on this money that we've borrowed are tax deductible. So, again, the next month, we've got our regular equity pay down that we're reborrowing. We've got the income from our investment. And we've got the little bit of refund that CRA is giving us. And we put all of that into here, into our investment. So we're increasing our investment size. And increasing the volume of this. So in the first few months, it's really not that big. But even over the course of the first year, you're going to pay down much more principal in your house than you would have from your normal conventional mortgage payment. The grand effect of all of this, generally speaking, is that you're going to take a conventional mortgage and pay it down 40 to 60% sooner. So if you've got a 25-year mortgage, maybe we're going to shave 10 years off it. There might be ways to even get up to shaving 15 years off it. And how are we doing that? Well, we've seen what we're doing is we're actually getting the government and the banks to pay it for us. What do I mean by that? Well, when we pay our interest costs, that goes to the bank, right? When we pay our taxes, that goes to the government. So, what we're doing now is by paying off years sooner, we're drastically reducing the amount of interest that we're going to pay on our mortgage. And we're also taking advantage of this debt swapping to get some significant tax savings that we recycle into this whole program. Therefore, we've got the banks and the government helping us to pay down our mortgage faster. Clear? Let's go to some real numbers now, and it will become a bit more clear still of what the real effect of this is.